Welcome to Advanced Projections December 2020 monthly update. Let's begin this month's forecast reviews with some further good news. Our expectations for a 15 to 20% decline in corporate earnings for the third quarter were too pessimistic, as it turns out. The final decline has only been about 6.2% as measured year over year. Although the S&P 500 lost almost 3% during the month of October, the reaction since then to election results and finalized earnings appears very positive in the short term, sending the markets back to higher records, but well into bubble territory now. The just announced usage approvals by the United Kingdom, the United States, and Canada for Pfizer's COVID vaccine certainly has added to the optimism in the equities markets. Other vaccines are in the approval pipeline as well. The GDP rate picked back up during the third quarter from the second quarter's 19.4 trillion per year to a nice recovery value of 21.1 trillion per year. We continue to expect further small increases in both the GDP and the velocity of money, a significant turnaround from just 2 months ago. As we said in last month's report, Recession 2020 has technically ended. Now for the underlying socioeconomic situation. We said last month that our expectations for COVID cases and fatality tolls would continue increasing through the end of 2020. As of now, December 9th, U.S. cases reached just over 15.7 million, an increase of more than 5.6 million in the past month, compared to 2.5 million in the previous month. New cases have soundly passed the rate of 200,000 per day, last month 100,000. And U.S. fatalities have reached 295,000, up approximately 57,000 or 24% versus last month's increase of only 13%. Fatality rates, which are fatalities divided by total cases, are pushing stubbornly up against 2% based upon average daily infection rates at the end of the month compared to average daily fatalities 4 weeks later. If we use the ratio of fatalities divided by resolved cases, the rate is much closer to 4%. Last month's numbers already implied that an overload of the healthcare system was in the offing again. Some locations are now confirming this. What we saw happen in New York City in late spring is likely going to happen soon in the new hotspots in the Midwest and Northwest states. Effects on transmission and mortality are anticipated to continue moving higher again due to continuing indoor business and education activity expansions and cooler weather, which implies that people are staying indoors more and in closer proximity to one another. Thanksgiving saw many travelers and group activities, and now Christmas and New Year holiday gatherings are coming up as well. Due to more stringent pandemic controls in other countries, they did not experience a midsummer second wave like the USA did. We are now in our third wave, one ahead of most of the rest of the world, and still at the top of both the total cases and total fatalities lists. In spite of having only 5% of the global population, we have more than 20% of the global cases and nearly 20% of the global fatalities. Globally, we expected cases to reach 35 million 2 months ago, and now they are at more than 69 million, up drastically in just the past month. That's an increase of more than 260% from the 19 million at the beginning of August. At this moment, there are nearly 500,000 new cases still being reported daily. By the end of this year, it would be a reasonable expectation for global case counts to reach at least 80 million, perhaps higher, and far higher than we originally expected. Global fatalities have now reached past 1.5 million, and it is likely that this number will be approaching 2 million by the end of 2020, just as we projected in our October report. Last month, we mentioned the downplay and happy talk surrounding the pandemic situation. Additional members of the government have reported positive test results. Vaccine test results and hopes for rapid deployment have added to the optimistic talk. However, it would still be optimistic to presume that under the best of circumstances, it will be mid-2021 or later before large numbers, i.e. tens of millions, of people can be given one of the vaccines currently approved or still under trial, and that it will be late 2021 or beyond for a fully available national vaccination program. The math is clear. With 2 doses required of the Pfizer vaccine and only 50 million doses promised for delivery over the next several months, less than 7% of the population can be vaccinated in the short term. Those first doses will undoubtedly be for healthcare workers, their immediate families, and for folks who live in high-risk environments such as nursing homes, senior living facilities, prisons, and other long-term group living situations. Other vaccines have yet to be approved, but when that happens, we may be able to reach 20% of the population by late spring. A useful figure for achieving widespread control of the pandemic is having at least 60% of the population vaccinated, and much greater compliance is required to actually eradicate it. 60% coverage would mean acquiring and distributing between 200 million and 400 million doses. During this 24/7 for 1 million doses per day still means at least 7 months of effort. Not an easy program to undertake and then actually attain the necessary compliance numbers. Now, the current economic environment in November, unemployment levels declined again somewhat to a national level of 6.7%, with another 245,000 returning to work from temporary furlough. Many more of the remaining temporary layoffs have become permanent ones, and the hardest hit industries are continuing with rounds of permanent layoffs. We anticipate that during the next few months, return to work gains will flatten further as outdoor seasonal and holiday work hours flatten and then decline. Indeed, the most recent unemployment report issued the morning of December 10th showed a large unexpected increase in new unemployment claims at 853,000 versus an expectation of 730,000. Anticipating a fresh set of holiday-related infections in the ensuing weeks, we think unemployment may move back up further, returning to the 8 to 10% area, but that will depend entirely upon the social and political responses to the massive COVID wave that will happen in the coming weeks. During earnings calls for the third quarter, nearly 80 companies of the S&P 500 expressed expectations for negative ESG impacts upon their fourth quarter and 2021 earnings. ESG stands for environmental, social, and governance factors. The equities markets continue to power ahead into bubble territory, and there are now many warnings being put out in the financial press as well as by indicators utilized by investment bankers that warn of a corrective environment forming for equities. We concur, but cannot really say exactly when the new market highs will stop forming. We will explain the negative environment with a few charts as we discuss the APSI indicator next, just below. Our APSI indicator looks at the relationship between current month-end S&P 500 equity closes and the ones from 4 months back, as well as comparisons to a set of long-term growth rates. In September, we published twice about the 3 indicators we use to establish whether the markets have entered bubble territory. Now, new highs have been occurring rather consistently within the past few weeks. In spite of third quarter earnings declining less than initially expected, the PE ratio of the S&P 500 increased to a point of more than double where it should be under normal circumstances. If this index were to remain absolutely flat at 3,700, the index's annual corporate earnings would have to increase year over year by roughly 25% for 3 solid years just to get back to realistic index valuations with a trailing PE of less than 20. This is an unrealistic expectation, to put it mildly. To a degree, a chart that we have provided courtesy of FactSet illustrates this particular problem. We will be watching market performance, and growing margin borrowing levels, our favorite tool for tracking speculative excess. The last peaks in margin borrowing showed up before the 2 large corrections of 2018, both of which we predicted. During this recession, margin debt has increased by nearly 40%, absolutely flying in the face of the recession and realistic prospects for the economy going forward. At an estimated $665 billion, margin debt is a mere $35 billion away from its all-time high of $700 billion, set at the end of 2017. Right now, it is about where it was when we first warned of the market correction of 2018. Circumstances, of course, are vastly different now, but heavy margin borrowing synchronized with market highs is a likely driver for a market correction beginning, quote, soon, unquote. Last time we said this, the correction began within 3 months, and it came in 2 waves during 2018. The latest information on margin debt is from October, shown in a chart from Advisor Perspectives, but we expect large increases in this to have appeared in November and December, concurrent with those months' market run-up, potentially into new record levels. November's closing value for the S&P 500 shows up as a red APSI indication, with that index now in blatantly overheated territory. As we said last month, we look for a return to red if that index closed out the month above 3570, and it actually ended at 3621, well past the mark. Another primary indication of the top-heavy nature in equities is the spread between the S&P 500 and 10% of the GDP, which continues to grow, as shown in our second chart. This is our form of what is more widely considered to be the Buffett indicator. Other AP status indicators are as follows. The APMS money supply indicator remains solidly green, of course, as the Fed continues with their expansion of the money supply, now reaching $18.7 trillion, up 20% since the first of the year. It also continues to warn Congress that the bottom layers of the economy are still suffering, and the whole economy will suffer lackluster growth if no new and significant stimulus is injected here. Additional stimulus has been dangled at us by some of the Congress, but with negotiations on further stimulus now moving lethargically, we still have the expectation that little real stimulus, or even nothing more, will come before the new administration and new Congress take the national helm in late January. Precious metals have steadied now, as all were showing upward price movements at surprising rates of increase earlier this summer. Gold spent all its time between $1,760 and $1,880 per ounce in November, down from August's temporary push above $2,000, which penetrated that mark for the first time in history. Recent action in gold prices showed testing of support levels in the mid-1700s. Silver behaved similarly during November, staying in the $22 to $25 range. Rhodium has moved up to new all-time highs as speculators moved in strongly. Month-end pricing for gold and rhodium keeps our AP-PM indicator deeply into the red. The October leading economic indicators from the Conference Board again improved slightly, but for this report, our AP-LI indicator still remains in the red. We expect lackluster LEIs to continue during the next few months, but our indicator may technically move to yellow for a month or two. The Conference Board has also warned of a flagging recovery and that we should expect a weak economy well into 2021. Due to the depressed yield curve, our APYC indicator remains yellow for this month. All Treasury short-term yields held at levels very similar to last month, while longer-term yields moved up around 20 basis points, reflecting a tiny bit more confidence in the economy. The Federal Reserve's weekly aggregate measure of economic stability has returned to a position of relative safety, but the Fed itself has remained with the NBER declaration of recession within all of their datasets. Fed charts for other data that we observe clearly show they have not cleared the bottom of the recession, and Recession 2020 is now 9 months in extent per the NBER. Therefore, our APFD indicator for this report remains red now for 8 straight months. This may change shortly, because as the third quarter 2020 GDP grew substantially upward from its enormous decline in the first half of 2020, the traditional measure of definitions of the recession have now pointed to a technical end of Recession 2020. The NBER nor the Federal Reserve have yet to take official notice of this technical end, but advanced projections declared that Recession 2020 has ended approximately 8 months after it began. But we do want to make an ominous note here. The root cause of the massive collapse that characterized the onset of Recession 2020 has not gone away. The economy now is much weaker than it was in January of this year before COVID hit our shores. Now, in a large third wave, COVID is spreading rapidly and is getting much worse. Control of this situation will determine if there is a second dip and perhaps a recession 2021. Real-time events will determine this, as the majority of our standard set of indicators have not even returned to green states, nor do we expect them to do so for many, many months. We have to basically rely on a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several months, which are inherently less reliable short-term indicators. So in summary, only one of our 6 indicators is in green territory. We are maintaining our probability of another near-term recession to 80%. We calculated that the actual onset of a recession had already begun over 9 months ago, a fact which was then confirmed by the NBER in June, and it became officially acknowledged by the Federal Reserve later in the summer with the adoption of NBER's declaration within the Federal Reserve datasets. However, as we have just noted, the technical end of Recession 2020 has now already occurred. Further modifications to this scenario will depend on what happens in the days and weeks ahead. Reviewing the events leading up to the Great Recession, there was a brief rebound before the serious declines of late 2008, within the context of an unbelievably risky economy just as we are facing now. Just like then, we have now almost concluded an election which portends a large shift in administrative policies. This time, there is the unique backdrop of a worsening pandemic and an ongoing, highly divisive political manipulation of social and economic expectations. So, final notes. We maintain that this is a very risky equity market environment with the potential for significant and protracted drops. Only those with the highest tolerances for risk should be speculating in the equities markets at these levels. High speculative valuations never persist, and a return to the mean, or worse, becomes more likely with each new disruptive influence. The only moderating influence in this scenario is that the Federal Reserve has indicated a long-term near-zero interest rate environment, and that tends to fan the fires of market speculation. This situation could persist for a couple of years, or some new, potentially black swan event could arrive to pop this bubble. Also, something we've begun to ponder here at AP is the economic setup for the 2020s. Is it possible for history to repeat itself in that we could expect to experience another roaring 20s as public relief and optimism take over once COVID is truly behind us? And despite the glossy reputation of the 1920s, there were 3 recessions in it before the big one. That's all we have for this month. Hope you found it interesting and useful, and please read our report, check out the charts, and stay safe, healthy, and happy through the holidays. Thanks very much, and we'll talk to you in January, just after the new year begins.